I love these bubble talks. Like, I just find it interesting because I'm a contrarian at heart. I'm seeing all these things. Bank of America's HeartNet says the Magnificent Seven stock bubble is still growing because the P to E ratio. I'm seeing this a lot. People saying it's not a bubble. First of all, the valuation metrics are not normal. And second of all, not every bubble is going to look the same. A bubble with a ton of small stocks at 200 PE is a bubble. And when 40% of every invested dollar in the world is sitting in 7 companies in the US, that can also be a bubble from concentration perspective. I love this line from Bank of America's Savita Subramanian.
Good luck. I know who we're talking about.
Quant strategy, but she had this line in this BofA report. S&P trades rich on 19 of 20 metrics. 4 just hit all-time highs. Market cap to GDP, price to book, price to operating cash flow, and enterprise value to sales are at fresh highs. Buying stocks at these multiples feels bad, but there are good ways, sales, EPS, GDP booms, and bad ways, price declines, to resolve this seemingly untenable situation. Or perhaps this situation is not untenable. The index has changed significantly from the 80s, 90s, and 2000s. Perhaps we should anchor to today's multiples as the new normal rather than expecting mean reversions to a bygone era. This sounds like a Tyler line.
Wait,
that is not what you hear at bottoms. I'm not calling for a top. I'm just saying asset selection matters. Know what you own. If you own SPY, you own 7 companies. That's all I'm saying.
Let's run the historical game theory here, because if you think about Why America and the Ponzi and all this stuff, if you go back and you read this book, it was Lords of Finance, The Bankers Who Broke the World by Liakata Ahmed. He talks about, like, in Germany, the only way to really retain your purchasing power was to go into stocks, because that was essentially the one way you could stay ahead of the inflation. There is a historical precedent. What I'm trying to say is having things at a higher valuation. When you think about the amount of money that needs to be printed to keep the liquidity going and satiate the debt so you don't have this massive global margin call. So you can make the argument that actually rings true from a historical perspective. And the amount of clowns I see that are just calling for a top because it feels toppy, I hate when I see that. But like when you hear someone really methodically, like there was another great one. I think Stan Druckenmiller was like, I tried shorting the market like 15 times in 2000 and I kept getting punched out because it kept going up and up. That's a top. When like you're trying to call a top and it just keeps going and it's ludicrous. There's so many things that the FANGs can do to keep the market going. They could issue massive amounts of debt, do a giant buyback. I was just in an Apple store getting a new iPhone and it was absolutely jam-packed in there. I feel like bubbles happen when people aren't in the store or where things roll over. There's so much financial engineering you can do here with credit. You could issue a bond at 6% and just buy back your stock. It's just like that will just keep happening. I don't understand. Why not just keep the leverage going? If they're diluting the currency at 8%, you're actually making 2% by issuing debt. Does that make sense?
I'm not saying this is right here at the top. I'm just saying you can believe we're in a bubble. You can believe the bubble's not done. You can believe it goes for however long you want to believe. And I don't think it's ending right now. But I can also pick the assets I want to play. My whole thing, I think this idea that when the easing comes that people want is I don't think it's going to be the same. I am sympathetic. Okay, maybe there's this view that to keep the plate spinning, we've seen government behaviors. They're going to add 30% or 40% of 50% to the supply of money to fix whatever problems arise. They've done it. Why not do it again? Okay, inflation's not terribly out of control yet. But then if that's what the market's saying, we should S&P at 24 times earnings or whatever it is because of that, that means then when it comes, then that's a sell the news or something. Like, because at some point when that comes and it's inflationary, then they can't ease like that. Or long-term interest rates go up and force multiples down. That's an outcome too. These companies might just grow earnings 12% every year for the next 5 years, but that's on the basis of 7% inflation in years 3 and 4, and multiples get cut in half because if you can buy a bond for 7%, you're not going to buy equities at 30 PE. It's just going to look really different is my point of how all this stuff evolves. And there's certain risk rewards that just to me are like the grossest thing ever. And one of those is Mag7.